Now that we are more than halfway through the year, let's do a financial checkup like we like to do here around the midpoint. So for some tips on what we should be looking out for, happy to have our good friend Paul Scatz, founder of Heritage Capital, LLC, back on the show. Good to see you, sir.
You too, my friend.
Yeah, glad to have you here. All right, first things first, let's start with the stock market. How's that been going, and how is that going to affect how people should be allocating their money?
So I sat here, what are we now, 7 months ago, and I thought we'd have a nice follow through. Last year's a great year. I thought we'd tack on 11 to 15%. So we're now 7 months into the year, and the Dow is up roughly 8.5%, 9%, and the Nasdaq's up 15. So we're kind of right where I thought we'd be at the end of the year, which means either I have to up my targets or we're going to chop around, maybe pull back a little bit.
Okay. It's an election year. Sometimes people try to factor that in. Should they be factoring it in?
So listen, Tim, I've done work back 100 plus years. There is no data-driven evidence that elections have any impact or the economy on the markets in an election year. So I tell investors, put blinders on, plug your ears. It's more of a media-driven thing than really an investment one. You can't build an investment portfolio. You shouldn't change your allocation because you love or hate Joe Biden or Kamala Harris or Donald Trump. It's irrelevant through this year.
Well, usually you say investing is more of a long-term strategy, and this, by definition, is a more transient instance. It comes, it goes, and you know,
markets hate uncertainty. Here's what we know right now. We know for certain that either Donald Trump is going to be the president or Kamala Harris is going to be the president. The markets have time to adapt and adjust and prepare. It'd be one thing if we woke up on Halloween and said, okay, Tim, you and Matt Scott are going to face off in the presidential race in the next 5 days. It's not what we have.
He'd kill me in a debate because he likes lying. I don't know, whatever. Sorry, Matt. Okay, I want to know about interest rates. One thing I remember you saying is that 3% is the new 2%, right? It used to be the Fed would want a 2% rate,
inflation.
2% inflation, jump year over year. And it looks like we're sort of slowing down to roughly 3%, like you said. It looks like you're on pace. Is it going to stay that way for a while? I mean, what do we think is going to happen?
So we're off of a 9%. Inflation began at 9 in 2021, really, in 2022. And we've now, the glide path has moderated down. It's going to be really tough to that last, if you're at the football game, that last quarter, baseball game, the last 8th or 9th inning, it's tough. So I do think 3% is the new 2%. Without a recession, huge qualifier, unless we have a recession, we're not going to get inflation down to 2%. In recession, although none of us root for it or want it, does a couple of good things. It does reset the whole economy. So mortgage rates and other interest rates and credit card rates and the jobs market. A lot of things will get fixed during recession, but a lot of us lose our jobs. And that's not good.
Yes, and for the most part, we've been able to avoid that. I mean, is it crucial to try to get it back down to 2%? I mean, it seems like we're chugging along fairly well on a macroeconomic sense at 3%.
So there's two ways to look at it. One, inflation is moderated. It's now, I'll put air quotes, only 3%, 2.5%. But you're the average consumer. We have high prices, even though prices are now only going up at 3%. Go to the grocery store, travel, do anything the average American does. It's really expensive to live. Go to Stop and Shop or ShopRite or even Costco. People bemoan prices. So is it important to get it down? Yes, over time. Are we going to get it down? No. Is there relief for the consumer? That's about all we're going to get.
Yeah, I mean, at this point, it just looks like make more money, which a lot of people have been doing, but that's just not as universal.
And you don't have control over it. It's much easier said than done.
Of course, absolutely. Specific advice, any retirees, people about to retire?
So congratulations if you're about to retire. That's great. So two things. One, if you're about to retire, make sure you can comfortably afford to do so, whether you've got pencil and an old piece of paper or you've got a spreadsheet, but map out what income you're going to take in each year and what your expenses are. Too many people retired in year 2000 and in 2007, right before the markets unraveled, 50+%, and they realized, oh boy, couldn't afford it because I relied so much on my investments to fund retirement. That's super important. And the other thing is, most investors who have stocks in their portfolio, they've gone up tremendously relative to where bonds did.
Yeah.
So if you're a pre-retiree or you're in retirement, your allocation's out of whack. Stocks went up too much. Bring that back into balance where your risk tolerance is what you hope it and you want it to be.
Okay, last question. What might we see over the next 6 months to a year? Any big shocks coming? Something, maybe the housing market? Some people might be worried that that's going to go down or crash or...
So interest rates, not the ones the Fed controls, which will be coming down in 6 weeks from now.
Yeah.
But other rates have started to come down very slowly. The economy is slowing. The unemployment rate is above 4%. If the unemployment rate does not go below 4% the rest of the year, the likely it is growth in the economy will trend towards zero. And I say zero, that's your best case. Your worst case is we're going to go negative and we're going to have recession. But if, again, the shocks are, it's never a shock we can plan for, right?
Right,
So
by definition.
we know that China could invade Taiwan. I take that off my list. We know a lot of things. The housing market, if growth slows in the economy, people lose jobs, the housing market will moderate, rates will moderate, and we all say, oh, that's great, except if you're the one losing your job.
Yeah.
But again, there's more risk in the stock market, and I love the market. Love the markets.
Always have.
But I think people should start to look at bonds, boring, stodgy, plain vanilla, yucky bonds, because the yields are fat right now. You can get more than...
Because the interest rates are up.
Right,
Yeah.
5% in a Treasury bill that's guaranteed by the full faith and credit of the U.S. government and not pay Connecticut state taxes.
Yeah.
People should not, leave their money in a bank earning under 1%. That's crazy, lunacy.
Yes, it's 5% guaranteed. Again, this is not a risk.
Full faith and credit of the U.S. government. Yes, sir.
There
it's
you go.
Actually, it's 5.33-ish right now. No Connecticut tax.
No Connecticut tax. There you go. And we've talked about how to buy them before, and maybe we should do some of that again. Paul Scatz, good to see you again.
Thank you.
From Heritage Capital LLC. Always a lot to get to in a short amount of time, but we get it done, Erica.